As of the market's close on October 6, 2025, Archer Aviation, trading under the ticker ACHR, closed at a remarkable $13.63, capping off a session that saw the stock surge by an astonishing 17.80%. This wasn't just a minor uptick, it was a violent move upwards, with the stock trading as high as $13.81 on the day, backed by an immense volume of over 152 million shares, a staggering 347% increase from its average trading volume. The immediate reaction is to get swept up in the euphoria. A nearly 18% gain in a single day seems to validate the entire futuristic narrative of flying taxis and urban air mobility. The expectation is that this is the moment the market finally gets it, that Archer is on an unstoppable trajectory to revolutionize how we move through cities. But the reality of what's driving this surge is far more complex and, frankly, more speculative than just a simple validation of its long-term vision. This explosive price action appears to be heavily fueled by a potent cocktail of social media hype, rumors of a potential partnership with Tesla, and a broader market re-rating of speculative, high-growth technology stocks. A promotional video featuring Archer's Midnight eVTOL aircraft alongside Tesla's Optimus robot went viral, igniting a firestorm of speculation. While there has been no official confirmation from either company, the mere suggestion of a collaboration with a titan like Tesla is enough to send a pre-revenue company like Archer into the stratosphere. This creates a critical tension for any serious investor looking at Archer through platforms like Schwab Intelligent Portfolios or Fidelity. The narrative is incredibly compelling, but the fundamental underpinnings are, at this stage, almost entirely based on future performance, not current performance. The common belief is that Archer is a frontrunner in the electric vertical takeoff and landing eVTOL space, and to be fair, there is substantial evidence to support this. The company has made tangible progress. It has secured a Part 135 air carrier certificate from the FAA, a crucial step that allows it to operate commercially and refine its systems. It boasts significant partnerships with established giants like United Airlines, which has a conditional order for up to 200 aircraft, and Stellantis, the global automaker that is providing manufacturing expertise and capital. These are not insignificant achievements. They provide a layer of credibility that many of its competitors lack. However, the contrarian take, the one that forces a re-evaluation, is to look at the immense hurdles that still lie ahead. FAA type certification for its Midnight aircraft, the final and most rigorous approval needed to carry passengers, is still in progress. The company is aiming for 2026, but the FAA has no precedent for certifying this new class of aircraft, which introduces a significant element of timeline risk. Any delay could substantially impact Archer's cash burn and test the patience of the market. Many users of SoFi Invest and Robinhood, who are often drawn to these kinds of high-growth stories, must weigh this regulatory uncertainty against the tantalizing market opportunity. Diving deeper into the recent market activity, the surge to over $13 a share is a dramatic departure from its 50-day and 200-day moving averages, which hover around the $9.55 mark. This indicates a sharp, sentiment-driven rally rather than a gradual, fundamentally supported climb. It's the kind of move that can create significant volatility, rewarding traders who get the timing right, but posing a substantial risk for long-term investors who might be buying in at a peak fueled by speculation. The institutional ownership, standing at over 59%, does lend a degree of stability and confidence. Major players have clearly done their due diligence and see a path forward. However, it's also worth noting the recent insider selling activity. Over the last 90 days, insiders have sold a significant number of shares. While insider selling can happen for many reasons, the complete absence of any open market purchases by insiders during that same period is a data point that cannot be ignored. It suggests that those with the most intimate knowledge of the company's day-to-day operations may not see the current stock price as undervalued. Let's talk about what ACHR Aviation actually does. The company is at the forefront of designing and developing eVTOL aircraft, which are essentially electric-powered air taxis. Their flagship Midnight is designed to carry 4 passengers and a pilot on short-distance trips, typically between 20 to 100 miles. The vision is to create urban air mobility networks that can bypass ground traffic, turning a 60-minute car ride into a 10-minute flight. The business model is multifaceted. It involves not just manufacturing and selling these aircraft, but also operating them as part of a ride-sharing network, creating a recurring revenue stream. The market potential is, by all accounts, enormous. Morgan Stanley has projected the urban air mobility market could be worth $1 trillion by 2040. ACHR, alongside competitors like Joby Aviation, race to capture a significant piece of that pie. This is the grand expectation that has investors so captivated. It is the story that powers the bull case often discussed on various online investing forums and social media platforms. However, the reality check comes when you look at the financials. ACHR Aviation is a pre-revenue company. In its last quarterly earnings report, it posted a net loss of over $200 million. The company's operating expenses are substantial as it pours capital into research, development, and the rigorous FAA certification process. While it currently has a healthy cash position of around $1.7 billion, its cash burn rate is significant. At its current pace, it will likely need to raise additional capital before it achieves profitability. This could come in the form of debt or, more likely, another equity offering, which would dilute the value for existing shareholders. This is a critical risk factor that any potential investor, whether they're doing self-investing on a platform like Interactive Brokers or using a managed service, needs to understand. The path to commercialization is incredibly capital-intensive, and the company's financial runway is a key metric to watch. Do you think the current cash reserves are sufficient to get ACHR to full commercial operation without further shareholder dilution? Comment below with your analysis. Looking toward the future, the outlook for ACHR Aviation is a study in contrasts. The potential catalysts are powerful. Successful completion of the FAA type certification for the Midnight aircraft would be a monumental achievement, removing the single largest overhang on the stock. The successful build-out of its manufacturing facility in Georgia with the help of Stellantis would demonstrate a clear path to scaling production. Any concrete news of a partnership with a company like Tesla moving beyond mere speculation would undoubtedly send the stock to new highs. The company's international expansion plans, particularly in the UAE and Japan, also present significant growth opportunities. These are the scenarios that could make the expectations surrounding ACHR a reality, rewarding investors who are willing to take on the considerable risk. A well-diversified portfolio, perhaps managed through Fidelity Wealth Management or similar services, might include a small speculative position in a company like ACHR to capture this potential upside. On the other hand, the risks are just as significant. The primary risk remains the FAA certification timeline. Any setbacks or delays could have a cascading effect on the company's finances and market sentiment. The competitive landscape is also heating up. Joby Aviation is considered by many to be further along in the certification process, and other well-funded companies are also vying for market share. There is also the risk of public perception. The concept of flying taxis is still novel, and public acceptance, particularly around safety and noise, will be crucial for widespread adoption. Finally, macroeconomic factors such as rising interest rates or a broader economic downturn could make it more difficult and expensive for a pre-revenue company like ACHR to raise the capital it needs to continue its operations. These are the realities that must be weighed against the high-flying expectations. Investors using platforms like the Fidelity mobile app or the Robinhood app, which make trading so accessible, must be disciplined and conduct their own thorough research. In summary, the dramatic 17.8% surge in Archer Aviation stock is a clear illustration of the tension between a powerful futuristic expectation and a more complex and uncertain reality. The expectation is a world of quiet, efficient air taxis whisking passengers over congested cities, a multi-trillion-dollar market ripe for the taking. The reality is a pre-revenue company burning through hundreds of millions of dollars, navigating an unprecedented regulatory process, and facing stiff competition, with its recent stock surge fueled more by speculative rumor than by fundamental shifts in its business. The partnerships with United Airlines and Stellantis provide a strong dose of reality to the bullish case, offering a tangible path to market. But the financial realities and regulatory hurdles serve as a powerful counterweight. The story of Archer from here will be about execution. Can it meet its ambitious timelines? Can it navigate the FAA's rigorous process? And can it do so before its cash reserves run low? The answer to these